Cell 1. In this cell, we're setting up a small system designed to generate an investor's risk profile based on their personal inputs. This is crucial because understanding risk tolerance is a key element in designing a suitable investment strategy. The system will take various factors, such as the investor's age, income, investment horizon, comfort with drawdowns, and experience level, to categorize them into one of three risk profiles: conservative, moderate, or aggressive. The logic behind this system begins with gathering inputs that significantly influence investment decisions. For instance, younger investors generally have a longer time horizon and might be more open to aggressive strategies, given their ability to recover from market fluctuations. Conversely, an investor who is closer to retirement may lean towards a conservative stance to protect their savings. The program will use these inputs to create an appropriate asset allocation, mainly focusing on stock-heavy suggestions tailored to the identified risk profile. As we develop this cell, it's important to highlight that these classifications rely on some assumptions. For example, the inputs need to be adequately representative of a typical investor's circumstances. In addition, there's a possibility that an individual might not fit neatly into one category, and nuances in their situation could impact their actual risk tolerance. As we build toward a simple machine learning classifier, we'll explore how to train this system to automatically predict an investor's profile based on their inputs, enhancing its usability and personalization. Looking ahead, the next cell will likely expand on the machine learning aspect, delving into how we can effectively train the classifier to ensure it accurately reflects real-world scenarios and investor behavior. This will ultimately refine our ability to guide investment decisions based on solid data. Cell 2. In this cell, we are identifying key features that will guide the development of an investment strategy tailored to individual investor profiles. Understanding these characteristics is crucial since they directly influence risk tolerance and investment behavior, helping us build a more personalized approach. We start by examining age, where we generally assume that older individuals tend to adopt a more conservative investment stance. This makes sense, as nearing retirement often encourages a focus on preserving capital rather than seeking high growth. Next, we consider investment horizon, where a longer time frame allows for more aggressive strategies. Investors with extended horizons can withstand volatility, making them more open to higher-risk assets. Another important feature is income stability. Those with consistent income streams may possess a greater capacity for risk, since they can support their lifestyle regardless of short-term market fluctuations. In tandem with income stability, we look at drawdown comfort, which is a crucial measure of how much loss an investor can tolerate during downturns. This metric is essential because it helps gauge emotional resilience in the face of market challenges. Experience also plays a pivotal role. Investors who have navigated various market cycles often feel more confident taking risks, as they have first-hand knowledge of potential ups and downs. Last but certainly not least, we differentiate between goals, focusing on whether the investor seeks growth or income. This distinction shapes their overall investment strategy, determining which assets to prioritize. As we progress to the next cell, we'll likely delve deeper into how these features interact with one another, ultimately guiding the creation of personalized investment portfolios. Understanding these elements equips us to refine our approach, ensuring it aligns with individual investor needs and risk profiles. Cell 3. In this cell, we're defining a function to classify individuals' risk tolerance based on a few critical personal and financial factors. Understanding risk tolerance is essential for creating effective investment strategies that align with a person's comfort level and financial goals. The function takes several parameters: age, investment horizon, how much drawdown a person can stomach, their income stability, investing experience, and their primary investment goal. Each of these factors influences a calculated score that ultimately determines their risk profile, which can be conservative, moderate, or aggressive. Starting with age, we see that younger individuals typically have a higher capacity for risk due to a longer investment horizon. The function awards points in a tiered manner, giving the maximum score to those under 35 and gradually decreasing it for older age brackets. Next, the investment horizon plays a similar role. Longer timelines allow for recovery from market fluctuations, which is reflected in the scoring mechanism. Drawdown comfort is particularly important, as it measures psychological tolerance for temporary losses. The function assigns higher points to those who can endure greater losses, showcasing their willingness to take risks. Income stability also factors into this equation. A more stable income is less risky and earns additional points. Investing experience influences behavior under market volatility, so the function accounts for whether someone is new to investing or more seasoned. The final piece is their primary investment goal, which can direct the type of risk they're willing to accept. After accumulating scores from all these variables, the function classifies the individual into one of three risk profiles, along with a suggested asset allocation. For example, a conservative profile leads to a heavier allocation in bonds and cash, minimizing exposure to market fluctuations. This function stands as a valuable tool for tailoring investment strategies to meet individual needs. In the upcoming cell, we will likely explore how to apply this function using real data inputs, enhancing our understanding of different risk profiles and their implications for portfolio management. Cell 4. In this cell, we're using a function called classify risk tolerance to simulate responses from an investor questionnaire. This is crucial because understanding risk tolerance helps in crafting a personalized investment strategy that aligns with an individual's financial goals and comfort levels. The workflow starts by considering several key inputs that reflect a hypothetical investor's profile. For instance, we have the age set at 32, indicating a relatively youthful investor, likely with a long-term horizon. This investor's time frame is defined as 20 years, which suggests a willingness to withstand market fluctuations in pursuit of growth. We also note their comfort with drawdowns, set at 35%, revealing an acceptable level of loss before they might feel uneasy. The inputs include a high income stability, which typically suggests less defensive positioning, and some level of investing experience that implies they've dealt with market dynamics before. Their primary goal, stated as growth, clearly skews their strategy towards more aggressive investments. As the function processes these variables, it will categorize the investor into a specific risk profile and provide a corresponding score, along with a suggested asset allocation. The output is designed to guide the investor in making informed decisions on how to allocate their portfolio, balancing risk with their investment ambitions. It's essential to recognize that assumptions embedded in this function can affect outcomes. For example, an investor's actual comfort with risk could differ from what they report, reflecting their emotional responses in real market conditions. Additionally, the classification may vary depending on broader economic variables not captured in the inputs. Looking ahead, in the next cell, we will likely explore how these outputs can actually influence investment recommendations and what it means for constructing a well-rounded portfolio. This transition won't just solidify our understanding of risk tolerance, it will also help connect our theoretical groundwork to practical investment strategies. Cell 5. In this cell, we're diving into the relationship between risk profiles and stock market strategies, which is crucial for any investor looking to align their investment approach with their comfort levels regarding risk. We categorize three distinct risk profiles: conservative, moderate, and aggressive, each with its unique characteristics and preferred asset allocations. Starting with the conservative profile, individuals in this group seek smoother returns and are cautious about significant downturns in the market. They generally gravitate towards dividend-paying stocks and low-volatility exchange-traded funds, embodying a value tilt. This means they typically hold a larger portion of bonds in their portfolio, aiming to cushion any potential losses. Importantly, their tolerance for maximum drawdowns, or the peak-to-trough declines in their investment, is generally less than 15%. Next, we shift to the moderate profile, which strikes a balance between risk and reward. Investors in this category are comfortable with normal market fluctuations and often prefer a core investment in the S&P 500. They typically adopt a blend of growth and value stocks, which helps diversify their exposure. Additionally, some international investments are part of their strategy. Their drawdown comfort level is slightly higher, ranging from 15 to 30%, allowing for more aggressive maneuvers compared to conservative investors. Finally, we explore the aggressive profile, where investors are not only recognizing that higher risks can lead to potentially higher returns, but are also prepared for significant volatility. This group often seeks maximum exposure to equities, with a strong tilt towards growth sectors, including technology and innovative fields. They may also venture into small cap and emerging markets, which can be more volatile, but often promise higher growth potential. For this profile, the comfort with drawdowns can reach 30 to 50%, indicating a willingness to weather substantial market swings. Overall, this cell provides a structured understanding of how different risk appetites directly influence investment strategies. As we move into the next cell, we'll likely explore how to practically adjust a portfolio based on these profiles, equipping investors with tools to align their strategies closely with their individual risk tolerances. Cell 6. In this code cell, we're diving into the development of a classifier that assesses risk tolerance based on survey data about potential investors. This analysis is crucial for tailoring investment strategies to different profiles, ensuring that recommendations align with individuals' comfort levels and financial goals. The first part of the code defines a function called classify risk tolerance, which takes various parameters, including age, investment horizon, comfort with drawdowns, and more. Each input significantly influences the risk score. For instance, younger individuals with a long-term investment horizon generally receive higher scores, reflecting their ability to withstand market fluctuations. The comfort with drawdowns is also pivotal. Those who can tolerate larger potential losses score higher. Additionally, the function incorporates qualitative assessments like income stability and investment experience, translating them into numerical values using dictionaries. Depending on the final score from these variables, individuals are classified into one of three distinct risk profiles: conservative, moderate, or aggressive. Each profile is linked to a suggested asset allocation strategy, guiding users on how to distribute their investments among stocks, bonds, and cash. Next, we shift to the generation of synthetic investor data through the Generate Synthetic Investors function. Here we simulate investor profiles in bulk, producing a representative dataset that includes diverse ages, investment horizons, drawdown tolerances, and other relevant attributes. The function leverages random number generation to create variability within these parameters, ensuring broad coverage of potential investor scenarios. After constructing the data frame with all these attributes, the function iteratively applies the risk tolerance classifier to each simulated investor. The resulting risk profiles and scores are appended to the data frame, giving us a comprehensive view of our synthetic investors. Finally, by executing this function to generate 3,000 synthetic investors, we obtain a dataset ready for exploration. This structured data will prove essential as we transition to subsequent analyses and model building tasks in the next cell, where we can apply machine learning algorithms to further refine our insights into the investment risk landscape. Cell 7. In this cell, we're diving into the training and fitting of a classifier, specifically a RandomForest model, to predict risk profiles based on our dataset. This step is crucial because effective classification can help us understand and manage financial risks more accurately. To begin with, we prepare our features for the model. By employing one-hot encoding, we transform categorical variables into a numeric format, making them compatible with the machine learning algorithm. The original data frame is modified by dropping the risk profile column, which we want to predict, while the labels are defined as the risk profile values. This differentiation between features and labels ensures that our model learns from the right data. We then proceed to split the data into training and testing sets. This division is essential for evaluating how well our model will perform on unseen data. Using a test size of 25% allows us to maintain a good balance, while applying a stratification technique ensures that the distribution of risk profiles remains consistent across the training and testing datasets. Next, we instantiate our RandomForest classifier with specified parameters, such as the number of trees and the maximum depth of the tree structure. These choices control how the model learns from the data. For this initial run, we set the random state for reproducibility. After fitting the model on our training data, we make predictions on the test set. To evaluate our model's performance, we utilize the classification report, which gives insight into essential metrics like precision, recall, and the F1 score. Interestingly, the results show that our model achieves perfect predictive capabilities in this instance. While this may initially seem impressive, it's worth noting that it prompts further inquiry. Are we overfitting to our training data, or is there inherent simplicity in our classification task? In this exploratory phase, we're intentionally refraining from fine-tuning hyperparameters, focusing instead on gaining insights into risk tolerance classification, which aligns with our overall objectives. Subsequent cells will likely build on this foundation, perhaps delving into model validation techniques or exploring ways to improve our classifier's robustness and generalizability. Cell 8. In this cell, we're diving into the process of predicting a new investor's risk profile using a machine learning model. This step is crucial because understanding an investor's preferences and risk tolerance can significantly enhance the effectiveness of investment strategies. At the heart of our function is the Predict Investor Profile, which takes three parameters: a trained model, a dictionary describing the investor's attributes, and a list of feature columns. The function begins by converting the investor's data into a data frame format, making it easier for the model to interpret. Importantly, categorical variables like income stability and experience are transformed into numerical representations using one-hot encoding. This transformation allows the model to better utilize this data while ensuring that it aligns with the columns it had been trained on. After aligning the new investor's data with the feature columns of the training set, guaranteeing that any missing data is filled with zeros, the model is called upon to predict the risk profile. It returns a numerical representation of the investor's risk tolerance based on the input attributes. In our example, we evaluate 3 different investors, each with unique characteristics such as age, investment horizon, drawdown comfort percentage, income stability, experience level, and investment goals. Each prediction output provides an insight into how well the investor might handle various risk scenarios and helps guide suitable investment decisions. It's essential to note that while the model is trained, assumptions about investor behavior and market trends play a significant role in the accuracy of these predictions. Pitfalls might arise if the features used in training do not fully represent new investor scenarios or if the market environment shifts drastically. As we look ahead, the next cell will likely build upon these predictions, analyzing them further to assist in crafting personalized investment strategies. This progression will take us deeper into tailoring investment solutions based on the insights we've gathered from the model. Cell 9. In this cell, we delve into the crucial concepts of risk tolerance and risk capacity, both of which are essential when evaluating investments. Understanding these concepts is vital because they help investors align their portfolios with their personal comfort levels and financial realities. Risk tolerance speaks to the psychological aspect of investing. It's about how much volatility or loss an investor can handle without panicking. For instance, an individual might wonder if they can emotionally withstand a situation where their investment drops by 30% in a single year. This kind of emotional resilience is fundamental in navigating the ups and downs of the market. On the other hand, risk capacity considers the financial aspect and addresses whether an investor can afford to experience losses. It's not just about comfort, it's about necessity. An investor might soothe themselves with the knowledge that they can ride out a downturn emotionally, but that doesn't matter if they need that money for essential expenses in the near future. Here, the intention is to develop a classifier that integrates both these dimensions. The goal is to provide a nuanced perspective on investment decisions, potentially leading to better outcomes for individual investors. However, it's crucial to recognize that these concepts can sometimes be at odds. An investor may have a high risk tolerance but a low risk capacity, which could lead to risky choices that are not sustainable. As we move forward, the next cell will likely build on this understanding by introducing methods to implement this classification into a practical framework. This will help us analyze investment choices more effectively by taking both emotional and financial factors into account. Cell 10. In this cell, we set up a dynamic web application using Dash to create a risk tolerance questionnaire focused on stock investments. This area of financial planning is crucial, as understanding an individual's comfort with risk can shape their investment strategy, ensuring both compatibility with their financial goals and psychological comfort. The application begins by defining a few key pieces: a dictionary called ETF mixes that outlines 3 distinct investment profiles: conservative, moderate, and aggressive. Each profile specifies a particular mix of exchange-traded funds. This allows us to tailor recommendations based on risk tolerance. The next step features the ETF pie function, which generates a pie chart displaying the composition of an ETF mix for a given profile. This visual representation helps users quickly grasp the allocation associated with their selected risk profile. Another essential function, allocation bar, creates a bar chart to represent the high-level allocation across various asset classes, like stocks and bonds. These visualizations aim to provide clarity on how risk is balanced within different investment strategies. One crucial point to note is the importance of user input. Various sliders and drop-down menus allow users to specify factors such as age, investment horizon, drawdown comfort, income stability, investing experience, and primary goals. As users adjust these inputs, the app triggers a callback that calculates their risk profile and produces corresponding visualizations. This integration of user interaction and dynamic visualization is key, as it fosters a more engaging experience. However, learners should be mindful of ensuring that input values fall within defined ranges to avoid errors or unexpected outputs. As we look ahead to the next cell, we will likely focus on the underlying logic that classifies the user's risk tolerance based on their inputs, further enhancing the application's functionality. This groundwork lays the foundation for making informed investment decisions tailored to each user's unique circumstances. Cell 11. In this code cell, we're conducting a Monte Carlo simulation to model expected investment outcomes across various portfolio profiles. And understanding these projections is essential for making informed investment decisions. By simulating multi-year outcomes based on capital market assumptions for stocks, bonds, and cash, this analysis gives us insight into potential future wealth trajectories, which can be especially valuable for financial planning. At the core, this simulation takes defined asset weights, such as those for stocks, bonds, and cash, and projects their returns over a span of 20 years, using a predefined number of simulations for accuracy. We start by establishing the assumed annual returns and volatility for each asset, as well as the correlation between them. These parameters help in understanding how the different asset classes might behave in relation to one another. Next, we calculate the covariance matrix, which plays a crucial role in generating realistic scenarios involving multiple assets. The simulation then generates annual returns for the three asset classes over the defined number of trials. By multiplying these returns by the specified weights, we compute the overall portfolio returns for each year's simulation. Following the returns calculation, we initialize a matrix representing the wealth outcomes over the simulation period, and populate it based on the returns for each year. This method enables us to visualize the potential wealth paths by projecting how initial investments evolve over time. We then turn our attention to the wealth fan chart, which summarizes the simulation results visually. This chart shows various percentiles, from the 5th to the 95th, allowing us to grasp the range of possible outcomes and understand risks as well as potential gains. Notably, we compare different profile strategies: conservative, moderate, and aggressive, each defined by its unique asset allocation. As we visualize these profiles, we can see that an aggressive strategy, although yielding a higher median ending wealth, may also exhibit a wider range of outcomes, including significant downside risks. Conversely, the conservative portfolio showcases a narrower range of outcomes with limited upside potential, highlighting important trade-offs inherent in investment strategies. Looking ahead, the next cell will likely deepen our exploration of these outcomes, perhaps by analyzing the implications of these projections in decision-making contexts, or considering how risk tolerance affects the choice of portfolio strategies. Cell 12. In this cell, we focus on a powerful technique for interpreting machine learning models called local reason codes. This approach, using Plotly for visualization, allows us to understand how specific features influence the model's predictions for individual instances. Such insights are crucial for building trust in model predictions and identifying which factors are driving outcomes. We start by defining a function that calculates these reason codes for a particular instance of data. First, we ensure the specified target class exists within the model's classes to avoid potential errors. The function retrieves a set of baseline reference values that represent typical data points, using the median for numeric features and one-hot encoded variables. This baseline is where we compare the feature's influence. After obtaining the model's predicted probabilities for our target row, we compute the impact of each feature individually. For each feature, we temporarily modify its value to the reference value and reevaluate the model's prediction probability. By comparing this modified probability to the original probability, we can calculate a delta, which tells us whether changing that feature tends to increase or decrease the likelihood of the predicted class. The output consists of a data frame that captures these deltas for each feature, including which direction they push the prediction regarding the target class. We then sort these changes by their absolute values to identify the top contributing features, allowing us to focus on the most influential aspects of the data. Next, we visualize these results in a horizontal bar chart using Plotly. This visualization nicely illustrates how each feature influences the prediction. We also add a reference line at 0 to help indicate the threshold between increasing or decreasing the probability of the target class. As we look towards the next cell, we'll likely explore how these insights can be leveraged for further analysis, or perhaps how they connect with broader feature importance metrics across the entire model. This will enhance our understanding of the model's behavior beyond just a single instance. Cell 13. In this cell, we're focusing on extracting and displaying key insights regarding the factors influencing certain outcomes in our model, specifically highlighting what attributes lean towards being aggressive and which ones do not. This step is crucial, as it helps us understand the underlying mechanics of the model, enhancing our interpretation of the results. The code begins by filtering a dataset named reasons that presumably contains variables along with their corresponding effects on a certain probability measure, referred to as delta prob. The logic here is straightforward. We want to identify the top 5 features contributing positively or pushing towards an aggressive outcome, and the top 5 that pull away from it. By applying the conditions of delta prob greater than 0 for the aggressive push and less than 0 for the pull, we efficiently retrieve a focused list of these influential factors. Using the head function allows us to limit our results to the 5 most significant features, which makes our output more digestible and useful. The filtered lists are then converted into a plain Python list format, ready for easy printing and visualization. This succinct output, which consists of the top pushing factors and the top pulling factors, allows for immediate interpretation. It's important to consider the assumptions built into this selection process. For instance, we assume that the ordering of our data in the original reasons data frame is indicative of significance, meaning that it is sorted in a manner that prioritizes the most influential factors. Any shortcomings here could lead to misinterpretations. Moving forward, the next cell will likely build on these insights, possibly visualizing the outcomes we've just summarized, or integrating them into a broader analysis. This continuation will deepen our understanding of how these features interact within the model framework. Cell 14. In this cell, we dive into the concept of local reason codes, a technique used to analyze how individual features impact the prediction probabilities of a classification model. Understanding this is crucial, as it helps us interpret model behavior on a granular level, revealing the contributing factors behind specific predictions. The function defined here, local reason codes, takes in a trained model along with a specific data row for evaluation, a target class name, a reference dataset, and a parameter for the number of top influential features to display. The heart of the function lies in quantifying the effect of each feature on the probability outcome by systematically replacing each feature in the input row with a reference value from the dataset. These reference values, determined by the median for continuous features or mode for categorical ones, are intended to represent a neutral baseline. Initially, the function captures the base prediction probability for the specified class, allowing it to gauge the shift in probability when individual features are modified. For each feature in the dataset, it creates a modified version of the input row where the particular feature is set to its reference value. This change lets us observe the difference in predicted probability, revealing how important each feature is in driving the model's prediction. The differences in probability, or deltas, are collected and then sorted to highlight the top influencing features. By focusing on the absolute values of these deltas, we can clearly identify which features have the most significant impact on the prediction. The final output is not only the base probability, but also a data frame containing the most critical features, ranked by their influence. In the latter part of this cell, a visualization is created using Plotly to display the top significant features and their corresponding probability changes. A horizontal bar chart is particularly useful here, as it provides a clear visual comparison of how each feature affects the prediction. The addition of a vertical line at 0 offers immediate insight into whether features are decreasing or increasing the likelihood of the class in question. Looking ahead, the next step will probably leverage these insights to enhance model performance or offer strategic recommendations based on the identified important features. This understanding can drive further exploration into model optimization, or even aid in feature engineering strategies. Cell 15. In this cell, we're diving into a key step in machine learning, assessing the importance of various features in predicting a target variable. Specifically, we're leveraging a RandomForest classifier to gain insights into how different attributes impact our ability to predict the risk profile of synthetic investors we've generated. This process is crucial because understanding feature importance helps refine models and make informed decisions based on data. We start by creating a synthetic dataset of 5,000 investors, which gives us a controlled environment to work in. Once we have this dataset, we need to prepare our data for modeling. This involves dropping both the target column, which is the risk profile we want to predict, and any potential leakage columns that might influence our results inappropriately. After that, we convert categorical variables into a numerical format using one-hot encoding, ensuring our model can interpret the data correctly. Next, we split the dataset into training and testing sets, using stratification to maintain the proportion of each class in our target variable. This is important for avoiding any bias that might skew our results. We then initialize a RandomForest classifier with specific parameters aimed at balancing complexity and performance. By fitting the model to our training data, we set the stage for evaluating its predictive capability. With the model trained, we employ permutation importance to assess the contribution of each feature in our test set. This method calculates the change in model performance when a feature's values are randomly shuffled, thereby gauging how crucial each feature is to the predictions. The results are organized into a data frame where we can see the features ranked by their importance. Finally, we visualize the top 20 features using a horizontal bar chart. This allows us to easily identify which factors hold the most significant influence over our predictions, providing actionable insights. It's important to recognize that these insights can guide us in refining our models and understanding the dynamics at play within our dataset. As we look ahead, the next cell will likely build on this foundation by applying these insights to optimize our model further or to explore additional aspects of our dataset. This will enhance our understanding of how different features interact and contribute to the predictive power of our models. Cell 16. In this final cell, we're wrapping up our analysis, marking the completion of our exploration. It's essential to reflect on what we've accomplished and consider how the insights gained will guide our next steps. At this stage, we have gathered valuable data, processed it, and drawn meaningful conclusions. This cell emphasizes not just the end of our current tasks, but also the importance of what we've learned throughout this notebook. We've dived deep into the relationships and patterns within our dataset, ensuring that any assumptions were carefully scrutinized. One thing to keep in mind is that while this marks the end of our current analysis, it also lays the groundwork for future inquiries. Any findings can serve as a springboard for further research or new questions to investigate. This iterative nature of data science emphasizes that even when one task is complete, new opportunities are always on the horizon. By wrapping everything up here, we're setting ourselves up for future projects that might require a similar methodology or exploration technique. So as we transition to what comes next, let's remember that every conclusion is merely a stepping stone to a deeper understanding or a new direction. In the upcoming cells, we will likely build on this foundation, possibly by applying what we've learned to new datasets or different analytical methods.